So hi guys, today I'm back with another new video. So today I will be covering you the text. So this module has 4 parts. I will be covering the module 1. The module 1 has balance sheet, income statement and comprehensive income statement. I will try to cover as much as possible in module 1. So module 1 starts with balance sheet. So under US GAAP, general purpose financial reporting is defined as a full set of financial statements and notes to the financial statements. A full set of financial statements typically includes these 5 things: balance sheet, PL, statement of comprehensive income, cash flow and statement of owner's equity. But in India we say balance sheet, in USA they say statement of financial positions. In India we say profit and loss, but in USA they say statement of earning or income statement. And we have statement of comprehensive income. Comprehensive income is those incomes which are not to be recorded now in profit and loss. Then we have statement of cash flows, then statement of owner's equity. Entity must present a classified balance sheet that distinguishes current and non-current assets and liabilities. We know the difference between current and non-current. Current are those which are to be realized within 1 year or within the operating cycle. When appropriate, a balance sheet presentation based on liquidity is also permissible. The following is the example of the classified balance sheet. So this is the example of the balance sheet. In India we see that the liabilities is on the left side and the asset is on the right side, but in USA they do the reverse, and in India we follow vertical statement, not a horizontal one. Over there they follow horizontal and vertical or vertical, but the thing is reverse. In India we, as I said, we have liabilities in the left hand side and asset on the right hand side, but they do the reverse. They have the asset on the left hand side and liabilities on the right hand side. So you all know that under current asset we have cash and cash equivalent, trading security, accounts receivable, notes receivable, inventory, prepaid expenses. Prepaid expenses is a part of current asset, the expenses which are paid in advance. And current liability have current portion of long-term debt, accounts payable, notes payable, interest payable, salaries payable, and unearned revenue, means the revenue which has not yet been earned but has been incurred. Investment available for in investment is a non-current asset. We have held to maturity securities available for sales. Then in long-term liabilities we have bond payable, deferred income tax liability, pension and other post-retirement benefits. Then in asset we have property. Under assets we have land, building, equity. These are all non-current assets. We have intangible assets, goodwill, patent, net of amortization. Amortization is the term which goes with intangible assets, and impairment is the term which goes with assets. Other assets have pension and other post-retirement benefit assets, deferred income tax assets. In liability side we have shareholders equity, capital stock, preferred stock, common stock. All the stocks, treasury stock, are liabilities. So moving on to the income statement, that is the PL. We need to know the terms used in income statement, that is the terminology. The purpose of income statement is to provide information about the uses of funds in the income process, means the expenses and the losses or the revenues and the gains. Uses of income statement: the income statement is useful in determining the profitability, value for investment purpose, and creditworthiness. The income statement is also useful in predicting information about future cash flows. Example, the amounts, timings and uncertainty of cash flows based on the past performance. The terminology: cost and unexpected cost. What is cost? Cost is an amount measured in money expended for items such as capital assets, services. Example, payroll and merchandise received. Cost is amount actually paid for something. So cost also includes the freight inward, means the transportation cost, or the all the cost which are incurred for bringing the machine to the current location. So cost is a vast term. Cost includes the purchase price of the machinery, and the installation cost is also incurred. If there is an engineer who is coming to the location for installing the machine, and all the expenses related with installation and all the expenses related to bringing the machinery to a country will also get incurred in cost. What is unexpired cost? Unexpired cost refers to the portion of a prepaid expenses that has not yet been used or consumed. What is prepaid expense? Prepaid expenses are costs that have been paid in advance but have not been incurred yet. So are the costs that will expire in future periods and be charged, allocated in a systematic and rational manner, or matched against revenue from future periods. Unexpired cost assets. So these are the examples of unexpired cost. These are the example of expired cost. Unexpired cost, we have inventory, unexpired cost of insurance, net book value of assets, unexpired cost of patents. What is patent? Patent is like royalty. If I make a book, then I will charge a patent, or if I make a software, I will claim a patent. I will create a patent so that no one else can use my software. Expired cost. Expired cost are cost of goods sold, insurance expense, depreciation expense, and patent expense which is amortized. Means after deducting, it's like depreciation. We use depreciation in terms of, in case of tangible assets, and amortization in case of intangible assets. Coming to the next one, gross concept. Gross concept means the value of revenue and expenses in total after deducting the taxes we get net, or after deducting all the exchanges, means exchange losses, exchange gains, or deducting the taxes we get net. So gross is the gross amount. After deducting all the things we get net. So study the gross concepts. Just I am going through what's revenue and expense. Revenue are reported in the gross amount of consideration to which the expenses expects to be entitled in exchange for the specific goods or service transferred. Expenses, on the other hand, costs that benefit only the current period, or the allocation of unexpired cost to the current period, are reported at the gross amounts. Net concept, as I said, gross less all the things, we have net book value, or the net concept. Gains or losses. Gains are reported at their net amount, that is proceeds less net book value. A gain is the recognition of assets either not in the ordinary course of business or without the incurrence of the expenses. That means gains are reported at their net amount. Means if there is gain, we do not deduct the gain. Means in the profit and loss, when we see a gain or loss, it's the net amount after deducting all the expenses. And losses, if I see, or if we see that there is a loss standing in the profit and loss account or the balance sheet, under retained earning the amount is negative, we will consider that it has been arrived deducting all the expenses. The third point is income from continuing operation. Income from continuing operations means income from the normal business. Means normally we have to calculate revenue minus expenses. Okay, so it's income from normal operation or income from continuing operation. We have multiple statement income, multiple step income statement, and single step income statement. In multiple step income statement, we will bifurcate them in, we will bifurcate the amounts in two lines, and in single step income statement we will only do one line. That is, over here we have sales revenue shown in the right side or in the outside, or and all the sales return less sales discount, all the expenses are shown in the inner column. We have two columns. So over here we need to calculate, that is sales revenue less sales return less sales discount. Then we will arrive at operating so the thing in the outer column, we see that all these are the revenues, and in the inner column all these are the expenses, right? The outer column are the revenues, the inner columns are the expenses. So we can do one thing, revenue minus expenses, we will come to final answer, then we will deduct the taxes, we can have this answer straight. But over here they have bifurcated in operating nature and financing nature. The operating nature are sales revenue, rental revenue and service revenue. They have written it separately. Net of sales return and sales discount means sales revenue less 25 less 5, it comes to 350. 380 minus 25 minus 5 comes to 350. Then we will add 200 and 100, it comes to 650. Then we will deduct cost of goods sold, cost of service sold and cost of rental income. These are of operating nature. So 410, we will deduct 410, it comes to gross margin. So we got the GP margin as 240, means these ones are the direct expenses. Now we are going to the indirect expenses. The indirect expenses are depreciation. Depreciation is 80, and then it says that salary expenses, there is a star, salary expenses 70, but it says the salary expenses $20 relate to salaries for salesperson, means $20 is for sales and $50 is salary for officers of the company. So we are having depreciation as 80, and general and administration expenses 50 will be our sales salary, and insurance expenses is 20. So 70 will be general and administration expense, depreciation expense is 80 and selling expenses is 100. So how this 100 came? This 100 came, this is the 20 of the sales. So, and we are having this 20, then we have commissions 40, then freight 25, then we have advertisement expense, that is 15. So adding 20, 25, 40 and 15, we get 100. Alright, so adding 80 plus 70 plus 100, we get 250. So 250, we have indirect expenses, we have gross margin as 240. So our loss from operation is 10. And then we are moving to the other income and other expenses. The other income are interest revenue, other revenue and gain on sale of available for sale of securities, that is 170 plus 130 plus 50, which stands to 350. Then we will deduct other expenses, interest expense, then loss on sale of fixed asset, then restructuring expense 100. We are getting 190. So income before income tax stands to 150. This is minus 10 plus 350 minus 190 stands to 150. Then we have income tax expenses. After deducting income tax expenses, we get 50. Then discontinuing operation, net tax of income. This one, last one, discontinuing operations, loss is 25, so we will subtract this 25, we are getting net income. So this is the multi-step income model. So coming to the single step income statement, is very easy. We just have to add all the revenues, 380 plus 200 plus 100 plus 170 plus 130 plus 50, and then we have to deduct all the expenses. See, we have added all the revenues, 350, 200, 170, 100, 50, 130, all the revenues. Then we will subtract all the expenses, and last we will show discontinuing operation net of tax. We will subtract it and we will come to net income. Alright, so moving forward to income from discontinuing operation. So discontinuing, there are two things which we need to show in our balance sheet and profit and loss, that is income from continuing operation and income from discontinuing operation. Discontinuing operations are reported separately from continuing operations in the income statement, net of tax. A discontinuing operations may include a component of an entity, a group of component of an entity, or a business or non-profit activities. Means it is not that we have to highlight the profit activity or we have to show only the profit activity. We can show the non-profit activity. Means if the company is incurring losses, then also we have to show it in our balance sheet or PL. Income reported within discontinuing operations can consist of an impairment loss. Impairment loss means if the asset value is 100 and if it got reduced to 80, then the impairment loss will be 20. A gain or loss from actual operation and a gain or loss on disposal. All of these amounts are included in the discontinued operations in the period in which they occur. Types of entities to be considered. So the types of entities which need to consider may be an entity or a group of entity. It may be business, a profit making entity, or a non-profit making entity. So when will be these discontinuing operations be reported? These discontinuing operations will be reported if it has been disposed of or is classified as held for sale. Means if the business has been sold off, then we will show discontinuing operation, or if the management is planning to dispose of the business, then also we will classify it as held for sale. Held for sale means we will classify it as held for sale. When the management classifies it as held for sale, then also we will show as discontinuing operations. Planned for sale, held for sale, all will be categorized as discontinuing operations. Conditions that must be present. What are the conditions by which we can say that the business is planning its discontinuing operation? Means the business is planning to discontinue its operation when there is a major disposal of geographical area, or there is a disposal of a major equity method investment, or there is a disposal of a major line of business. Means if, for example, if in India a major portion have been sold off by the company in the specific geographical location, or a major equity has been bought back, or there is a change in the equity method, or there is a disposal of a major line of the business, a business has closed some of its operations, some of its main operation, then we must consider that the business is going to dispose in near future. A business or a non-profit activity that on acquisition meets the criteria to be classified as held for sale is a discontinuing operation. Means whenever the management classifies as held for sale, then it's a discontinuing operation. It is to be treated as discontinuing operation. So there is an illustration of discontinuing operation, that is AmServe Inc. is a food service company that delivers frozen food product for food service providers. Its clients includes fast food restaurant, high-end steak houses, home delivery, diet food companies, and institutions such as schools and hospitals. Historically, the fast food restaurant have been the largest segment of serves business. The fast food restaurant is the largest segment of M serves business in terms of revenue and operating profit. However, the division is now forecasting to begin to decline in revenue because the public is looking for healthier option. M serve has decided to sell its fast food operation and instead focusing on selling to locally operated restaurants offering a healthier fare. Such restaurants will generally show but higher. Okay, because the fast food division is the largest component in terms of revenue and operating profit, the disposal represents means over here we just have to find two things, that is either it has been sold or it has been decided to sold. See over here M serve has decided to sell means we have to report discontinuing operation. So how to find discontinuing operation? We have to look for two things, either the business has been sold or it has been planned to sell or decided to sell. So over here M serve has decided to sell, so it's to be reported as discontinuing operation. Moving to the next one, discontinuing operation calculation. How do we calculate discontinuing operation? Types of items included in results of discontinuing operations: result of operations, gain or loss on disposal, impairment losses. So initial and subsequent impairment losses. A loss is recognized for recording the impairment of the component, that is any initial or subsequent write down to fair value of the asset is to be considered as impairment loss. Subsequent increase in fair value, if there is a subsequent increase in fair value, a gain is to be recognized for subsequent increase in the fair value minus the cost to sell, but not in excess of previously recognized cumulative loss. That means in simple term, subsequent increase in fair value means if our asset is for $100 and if it goes to $120, so we need to record $20 as gain. And for impairment loss, if our asset is $100 and if it goes down to $80, so the $20 will be loss. Next one is report in the period disposed of or held for sale. Means when it is disposed of or held for sale, we need to report in our financial statements. Means the result of discontinuing operation of a component are reported, means it needs to be reported. It is compulsory that you have to report in discontinuing operation in the period of the component is in which it is disposed of or is held for sale. The result of subsequent operation of the component classified as held for sale are reported in discontinuing operation in the period in which they occur. Okay, so it says that after it has been classified as held for sale, then it will be categorized under discontinuing operation. Depreciation and amortization. Depreciation is for tangible assets, amortization is for intangible assets. Measurement and valuation. So we have to measure the cost lower of its cost or carrying value. See, carrying amount of fair value or the cost to sell. Means we have to measure the component lower of its carrying value or cost, but if it's held for sale or if it's a discontinuing operation, then we need to categorize it in fair value. But for example, the fair value is 100 and the cost is 80, then we will follow lower of cost or fair value. But if the fair value is 80 and the cost is 100, then we will categorize it under 80, which means when an asset or a disposal group is classified as held for sale, it indicates that it will be sold in present future within 1 year most probably, and it's highly probable that the sale will occur. In such cases, it's required to be measured at the lower of its carrying amount and its fair value. This ensures that assets held for sale are not overstated on the balance sheet and that any expected losses on disposal is recognized in a timely manner. Then coming to presentation and disclosure. Present as a separate component of income, the result of discontinuing operations net of tax are reported as a separate component of income below income from continuing operations. So the income from continuing operations we have to present first, and then below it we have to present income or loss from discontinuing operations. Then we also have to disclose in face or in notes of accounts the gain or loss from discontinuing operation. Then coming to example 3, discontinued operations calculation. Okay, so facts. The trial balance below presents the income statement accounts for year 1 from all sports companies' trial balance. The golf division of all company has been losing money, so they have decided to sell this golf division. Okay, the board of directors decides on April 30 year 1 to dispose of the golf division. So the golf division needs to be disclosed as discontinuing operation. The carrying value of the golf division on April 30 year 1 is 40 lakhs and its fair value less cost to sell is 22 lakhs. So the carrying value is 40 lakhs and the fair value less cost to sell is 22 lakhs. After months of negotiation, the division's net assets are sold on 30th June year 2 for 20 lakhs. So we can see there is a gap. So there is a loss. The golf division has continuing loss in year 2 of 2 lakhs per month. So in the year 2 there is a 2 lakh loss per month. All sports income, there is a continuing loss of 2 lakhs per month. This is important. We need to remember it while solving the sum in period 2. All sports income tax. The income tax is 40% for both the years. Assume that all sports income from continuing operation is 48,75,000 in year 1 and 52 lakhs in year 2. So one thing you all might be asking, that what is all this 4,000, 5,000, 5,300, all these are not important because these are the pre-filled amount in the tax software. When you will write sales revenue, this 4,000 will automatically come. When you will write commission, this 5,400 will automatically come. So it is already there in all the tax software. This is not important for our purpose. So all components and golf division, all component is under continuing operation and golf division is under discontinuing operation. So we have to deduct all the cost from sales revenue. See, for reporting year 1, the golf division was not disposed of until year 2. So the golf division got disposed of only in year 2. When it got disposed? It got disposed on June 30 year 2. That is January, February, March, April, May, June. We have 6 months in period 2. So the loss which is there in period 2 is, this continuing loss is for 2 lakhs into 6, that is 12 lakhs, 12 lakh loss. So let us solve the solution. Loss from operations, that is 25 lakh, this 25 lakh, sales revenue 25 lakh, less we need to deduct all the expenses. That is, after deducting all the expenses, we get a loss of 2,40,000. See, from 18,50,000 to 4,95,000, all the expenses are deducted. So after deducting revenue from expenses from revenue, we get loss, and then we need to deduct tax on loss. So our loss gets reduced. So this means that we have to pay less tax. This is net, and even if you calculate 24 lakhs minus 40%, you will come to this one. Wait. Let's show you all in calculator. So we have this 24 lakhs and we need to deduct tax. That means we can either subtract this 40% or we can do net of tax. Means 1 minus 40%, that is net of tax, will be 14,40,000. And we have impairment loss also. See this, the division net asset are sold on for 20 lakhs. The carrying value of the asset is 40 lakhs and its fair value is 22 lakhs. So the impairment loss is 40 lakhs less 22 lakhs, which stands to 18 lakhs. So we need to deduct the taxes. So net of tax 1 minus 40%, that is 60%. So net of tax comes to 10,80,000. So we are having this 10,80,000 as impairment loss net of tax. So how we will present it in income statement? In year 1, income from continuing operation, it's said over here that income from continuing operation for year 1 is 48,75,000. So 48,75,000. Then discontinuing operation, we calculated this section, that is the golf division. We have 14,40,000 and impairment loss net of tax, all will be net of tax. Loss from operations of discontinuing operation 14,40,000 less impairment loss 10,80,000, which comes to 23,55,000 in year 1. So we need to report in year 2 also loss from operation. As said earlier, loss from operation 2 lakhs loss per month for 6 months till it's April 30. So from January to April it's 6 months. So 2 lakhs into 6, 12 lakhs. Loss from operations net of tax will be 12 lakh net of tax, 12 lakh into 1 minus 40%, that is net of tax 60%, that is 7,20,000 will be loss from operation. And loss on disposal, that is after impairment the carrying value stands at 22 lakhs, but after negotiation the company sells it at 20 lakhs. So there is a loss of 2 lakhs. So there is a loss of 2 lakhs. Net of tax it comes to 1,20,000. So presenting it in income statement, the income from continuing operation is 5,20,000. Income from continuing operation in year 2 is 5,20,000 in year 2. In year 2 income from continuing operation and income from discontinuing operation, that there is a loss 7,20,000 and loss from disposal, that is 1,20,000, which stands to net income as 43,60,000 in year 2. Then foreign currency transactions, I will continue this in my next class. Thank you. Please like, subscribe, and please do write a comment if I need any improvement or you all need any more elaboration of any concepts. Thank you. Best of luck.